Hey everyone, Colin Tedards here. And as we start to close the door on this year, we're going to start to strategize for 2024 and start kind of preparing for any kind of market shifts that come our way. The first thing that we have to think about are interest rates. Now, if you think the Federal Reserve cutting rates only sends markets higher, you need to pay attention today. That's because right now there's kind of a two-pronged consensus. Market expectations lean toward the Federal Reserve reducing rates by May of 2024. That would be about 10 months following the last rate hike that we had in July. Now, recent history proves this 10-month time frame between the last rate hike and the first rate cut, that would actually be a pretty long time historically for the Fed to change course. The only exception being in September of 2007, which occurred about 15 months after the cycle's last hike. So look, either way you slice it, if history is our guide, the Federal Reserve is set to cut rates in 2024. But here's where things actually get really interesting. The consensus is that rate reductions, this is going to favor consumers, it's going to favor investors, and really the overall stock market. While I totally believe that consumers and businesses will benefit and welcome lower credit card interest rates, mortgages, and borrowing rates, the impact on the stock market has actually been really, really bad. Reviewing the past 9 initial rate cuts, the S&P 500 index has averaged a 20.5% decline in the months that followed the initial rate cut. This includes severe market crashes in 2002 after the dot-com bubble burst, and in 2008 and 2009 during the great financial crisis. While investors have been trained over the past 2 decades or so that lower rates are only good for markets, the bottom line is when the Federal Reserve begins its rate cutting cycle, which again should occur sometime next year, it means there's a very good chance a severe market downturn is actually right around the corner. But if that has you concerned, there's actually more that we need to unpack here. So looking out kind of on a longer time frame, the picture starts to change. 6 months after the initial cut, there's an average of a 3.4% return on the S&P 500 index. Even further down the road, clearly the depths of the great financial crisis and the dot-com crash, those were fantastic times to accumulate stocks and build wealth. I know this firsthand. Now, here's the important part for all of you. How do you prepare for a 2024 that's likely to be a little bit more volatile as the Federal Reserve starts to change course? The first thing we're doing for our paid subscribers over at Legacy Research is on the near future report and exponential tech investor. We're going to start to move our stop losses higher as we close out the year. So if you're a subscriber over there to either or both of those services, keep your eye on your inbox. We'll send those updates later this week. Setting your stop losses now when market conditions are kind of calm and good, this is going to remove the emotions that can lead to a lot of mistakes when the markets start becoming volatile next year. And the next thing is create a shopping list. Again, do this when your emotions are not impacted by a market crash. Aside from kind of the technology stocks that are wrapped up in the AI megatrend that we're really excited about and that's unfolding, I have my eye on several sectors right now that are going to benefit from lower interest rates. And I'll share those sectors with you in a future video here in the coming days. Now, finally, let's be prepared to be far more active in 2024. Again, history proves that when the Fed starts cutting rates, it can actually trigger a market crash. In fact, it does it more often than not. And fortunes are made by investors who know how to capitalize during those moments. That was the Bleeding Edge for today. I look forward to seeing you again soon. Good luck with your investments.